Everyone remembers 2008. Some still feel the sting of 2020. But almost no one talks about the day the US market collapsed, on Christmas Eve. December 24th, 2018. The S&P 500 was on track for its worst December since the Great Depression. The Dow Jones had already lost 4,000 points. And on the day markets closed for the holidays, the Nasdaq officially entered bear market territory, down over 20% from its peak. The headlines blamed it on a tweet. Donald Trump had lashed out at the Federal Reserve. He didn't like how they were raising interest rates. Wall Street, the press, and even parts of his own administration blamed the volatility on presidential interference, a confidence crisis, a communication error. But look closer and something doesn't add up. A few angry tweets didn't wipe $5 trillion off global markets. This wasn't just about hurt feelings at the Fed. It was about tightening liquidity. The invisible fuel of financial empires was being withdrawn, and few understood just how fragile the system had become. You're told it was a correction, a hiccup, but we argue something else. The Christmas crash of 2018 wasn't an accident. It was a stress test, one that exposed the growing tension between fake growth and real cost, between markets pumped by free money and the cold arithmetic of rising debt. And more importantly, it was a warning, because everything that shook in 2018 is set to break in 2026. We're going to walk through it, not just the crash, but the deeper structure behind it, why the liquidity dried up, who drained it, and why every empire, whether a 19th century colonial bank or a 21st century central bank, always reaches this point, when they have to choose between inflation or implosion. So if you've never heard of the Christmas crash, or if you thought it was just a blip, then pay attention, because behind the charts and jargon was a structural warning, and it's coming due. If this already feels like a missing chapter of the financial story, drop a comment with where you're watching from. Let's keep going. To understand why the markets cracked in December 2018, we have to go back. Not just a few months, but a decade. Because crashes don't begin with fear. They begin with engineering. The financial system that buckled in 2018 was built after 2008 by the very people who were trying to save it. Let's set the stage. It's 2009. The global economy is on its knees. Lehman Brothers is dead. AIG has been bailed out. Wall Street is radioactive. And into this chaos steps the only institution that still looks stable, the U.S. Federal Reserve. But stability is not enough. The Fed has one job: keep money flowing, keep credit alive, keep the entire fragile machine turning. So they do what no central bank had ever done at this scale. They begin quantitative easing, QE, which is a fancy way of saying we're going to print money to buy things no one else wants. At first, they buy government bonds, then mortgage-backed securities, eventually corporate debt. By 2014, they had poured over $4.5 trillion into the system. The theory? If the Fed injects enough dollars into the bloodstream, the patient will recover. And for a while, it seemed to work. Markets roared, asset prices soared. A new tech boom was born: Apple, Amazon, Facebook. The Nasdaq shot through the roof. But here's the catch. This wasn't real growth. It was liquidity-fueled growth. And liquidity, that's not just money. It's trust, leverage, and velocity. It's how fast money moves, how easily you can borrow, how cheaply you can refinance debt. Now imagine what happens when that fuel is pulled away. That's exactly what began in 2015 and intensified in 2017 to 2018. The Fed, now afraid of creating inflation or bubbles, began normalizing monetary policy. That meant two things. First, raising interest rates. Second, shrinking the balance sheet, which means they stopped buying debt and started selling it. Between 2017 and 2019, the Fed's balance sheet shrank by nearly $700 billion. That might not sound like much until you realize the modern market had become addicted to ultra-cheap credit. Think of it like this. For 9 years, the Fed was the bartender at a free champagne party. Then, in 2018, they not only stopped pouring, they started taking bottles away from the table. And who was sitting at that table? Banks, hedge funds, private equity, tech giants, pension funds. Every corner of the market had structured itself around cheap borrowing. Corporate America had taken the Fed's 0% rates and gorged on debt. Not to build factories, but to buy back their own stock. In fact, by 2018, U.S. companies had racked up $9 trillion in corporate debt, much of it at artificially low rates. Even worse, these debts had short maturities. They needed to be rolled over constantly, meaning companies had to keep borrowing to pay back old loans, which was fine as long as money stayed cheap. But as soon as the Fed began tightening, the math began to break down. Here's the thing most people miss. The 2018 crash wasn't caused by fear. It was caused by a deliberate change in plumbing. The Fed didn't just raise rates. They began draining the system's liquidity, not from Wall Street headlines, but from the repo market, the reverse repo facility, and the short-term funding mechanisms that keep money moving overnight between institutions. That's like pulling oxygen from a room and wondering why the plants start dying. And remember, this wasn't just the Fed. The European Central Bank, the Bank of Japan, and the People's Bank of China were all signaling tightening. From 2017 to 2018, the global monetary base, the foundational layer of all money, shrank by nearly $1 trillion. That's a coordinated deflation of the monetary cushion the world had been sleeping on. So by December 2018, the pressure was immense. Debt was rising, growth was slowing, liquidity was vanishing. And into that fragile situation, the President of the United States tweets that he doesn't like the Fed Chair Jerome Powell. That wasn't the cause. It was the spark. The fuse had been laid years earlier, and the real architects weren't tweeting. They were sitting at the FOMC, adjusting interest rates, and pretending that the system they built was still under control. But control is an illusion when your entire economy depends on free money. Let's talk about the illusion. The kind of illusion that makes you believe prices only go up, that central banks have everything under control, that debt isn't dangerous as long as you can roll it over, and that somehow this time is different. Between 2009 and 2018, that illusion ruled the world. Markets surged, credit flowed like wine, and anyone who doubted it, who questioned the sustainability, was laughed off as paranoid or not understanding the new paradigm. But there was no new paradigm. There was just cheap money. Remember, after the 2008 crisis, interest rates were dropped to near zero. But here's the catch. They never really went back up. The entire decade became one long emergency, extended for the benefit of markets, not the real economy. The Federal Reserve said it was stimulating recovery. But what actually recovered? Corporate profits, stock prices, tech unicorn valuations. What didn't recover? Wages, savings, middle-class stability. And yet, the illusion persisted, because markets don't care about fundamentals. They care about liquidity. So long as the Fed was printing, asset prices floated upward, and those who played along made fortunes. This is when the buyback era exploded. Corporations, flush with cheap debt, began issuing bonds to buy back their own shares. It was the perfect loop. Borrow at 1% to 2%, push up your own stock price, cash out executive bonuses, repeat. Between 2009 and 2018, S&P 500 companies spent over $5 trillion on stock buybacks. That's more than the GDP of Japan. And investors called it capital returns. But it wasn't capital creation. It was financial engineering. It made the charts look healthy, but under the surface, real growth was weak, uneven, and increasingly dependent on leverage. The tech sector became the poster child for this fantasy. Apple, Amazon, Google, Facebook, they grew explosively, sure, but their valuations weren't just about earnings. They were about expectations. Expectations fueled by 0% interest rates. In a world where bonds paid nothing, stocks seemed like the only option. That's how the acronym FANG was born. Facebook, Amazon, Netflix, Google. Symbols of unstoppable, central bank-fueled growth. But here's the problem with illusions. They require maintenance, and that maintenance costs more and more over time. By 2017, the cracks were already showing. Global debt had reached $250 trillion. That's over 300% of world GDP. Productivity growth was stagnant, and asset bubbles were forming everywhere, not just in housing, but in everything from art to Bitcoin. Still, the party continued, because every time volatility appeared, the Fed signaled it would step in. It was called the Fed put, a simple idea. If markets fall too far, the Fed will cut rates or print money to stop it. Investors believed this like a religion, and so they took more risk, borrowed more, and pushed asset prices even higher. It became a feedback loop. Markets went up because people believed the Fed wouldn't let them go down. It's the same psychology that drove France's assignat in the 1790s. Print more and prices will stabilize. Or Argentina's peso in the early 2000s. Keep borrowing and growth will come. It never ends well. But during the illusion phase, it feels like genius. And in 2018, that illusion was still alive. Barely. Every fund manager, trader, and financial analyst knew the Fed was tightening. But they believed, or hoped, that Powell wouldn't let markets fall too far. They were wrong. Because in the final weeks of 2018, the Fed did something unusual. They kept hiking rates, even as markets were dropping. It was the first real signal that the put might be gone. And for those leveraged to the hilt, long on tech, long on corporate debt, long on blind optimism, it was like the lights flickering at the casino. Not off, not yet, but enough to make everyone stop and look around. Because when an illusion breaks, it doesn't do so slowly. It shatters all at once. It began slowly. December 2018 looked like a normal correction. At first. Markets had dipped in October. Nothing unusual. A little turbulence before the end of the year. That's what the pundits said. But by mid-December, the dip turned into a free fall. On December 17th, the S&P 500 closed at its lowest level of the year. Apple lost over $400 billion in market value in just a few weeks. Oil prices collapsed below $50 a barrel. The high-yield bond market, known as junk, completely froze. Not a single deal was priced for the entire month. And by Christmas Eve, when markets traditionally close early in low-volume calm, the Dow had shed nearly 20% from its October peak. This wasn't just volatility, it was a structural break. What broke? Liquidity. That invisible force that keeps markets moving, the lubricant of the global financial engine, dried up almost overnight. Why? Because the math finally stopped working. Let's explain it simply. When interest rates rise, two things happen. First, debt becomes more expensive. Second, the value of previously issued debt falls. That means companies, especially those with large, short-term debt, suddenly face a wall. They need to refinance, but at higher rates. Their old bonds are worth less, and new investors demand a higher yield. This is what's called a duration mismatch, a polite way of saying you're trapped. In 2018, U.S. corporations were holding over $3 trillion in BBB-rated debt, one notch above junk. If rates kept rising, those bonds would be downgraded. And if downgraded, institutional investors, like pension funds, would be forced to sell. A cascade would follow. It nearly happened. Behind the scenes, credit markets were buckling. Even the most liquid instruments, corporate bonds, overnight lending, repo operations, were becoming dysfunctional. This wasn't just panic, it was a chain reaction set in motion by arithmetic. Because debt has no ideology. It doesn't care about presidential tweets or investor optimism. Debt has one rule: you must pay it back or roll it over. And when that becomes mathematically impossible, politics doesn't matter. Even Jerome Powell, chairman of the Federal Reserve, seemed slow to grasp this. On December 19, 2018, the Fed raised interest rates again for the fourth time that year. Markets begged for a pause. Instead, Powell delivered a dry press conference signaling more hikes in 2019. Wall Street didn't just hear tightening, they heard indifference. And the markets responded. Within hours, the Dow plunged over 350 points. By the end of the week, it had lost another 6%. That brings us to Christmas Eve, December 24th, 2018, a half-day trading session. Most people were offline, shopping, wrapping presents, and yet markets had their worst Christmas Eve in history. The Dow fell over 650 points before the close. The S&P 500 was down over 15% for the month. The Nasdaq officially entered a bear market. But the most revealing moment wasn't on a chart, it was at the Treasury. That weekend, Treasury Secretary Steven Mnuchin made an unusual phone call to the CEOs of the 6 largest U.S. banks. He then released a public statement assuring Americans that bank liquidity is strong. No one had been worried about bank liquidity until he said that. It was like someone entering a room and yelling, "Don't panic," to a crowd that wasn't panicking. Until now. The result? Panic. The illusion snapped. For one brief week, the old belief that central banks and governments had it all under control dissolved. It became clear. They didn't. Behind the headlines and hashtags, behind the suits and sound bites, the system was held together by a single fragile thread, cheap debt. And once that thread was pulled, everything else unraveled. The paradox? The very institutions that created the problem, the Fed, the Treasury, the banks, were the ones now expected to solve it. But you can't solve a fire with more gasoline. You can only pause it, delay it, buy time for the next one. That's what happened in early January 2019 when Jerome Powell abruptly reversed course. He paused rate hikes, then signaled cuts, then hinted at more QE. Markets recovered temporarily, but something had changed. The myth of control was broken, and behind it, the math remained. The system hadn't deleveraged, it had merely hit pause. If you understand that, you understand why 2018 wasn't the crash, it was the dress rehearsal. 2018 should have been the end of the story, a near miss, a lesson, a turning point. But what actually happened? The fire alarm went off, and instead of rewiring the building, they just turned the alarm off. Let's be clear. After the Christmas crash, the Federal Reserve reversed course not because the fundamentals improved, but because markets demanded it. It was the return of the Fed put, the belief that as long as markets screamed loud enough, the central bank would cave. So Jerome Powell pivoted. Interest rate hikes were paused, then reversed. And by September 2019, the Fed was once again injecting liquidity into short-term markets, this time under a new name, not QE. But here's the thing. If it walks like QE, prints like QE, and bails out over-leveraged players like QE, it is QE. By the end of 2019, the Fed had injected over $400 billion back into the banking system. But the real explosion came in 2020. COVID was the excuse, but the machinery had already been rebuilt. Between March and June 2020, the Federal Reserve created more new money than in its entire history combined, over $3 trillion in just a few months. The balance sheet exploded past $7 trillion, and then $9 trillion by 2022. And once again, it worked, temporarily. Markets soared. Bitcoin hit $60,000. Meme stocks went to the moon. SPACs, NFTs, real estate, tech, all back on a cocaine drip of printed dollars. But here's the problem. They printed demand, but not supply. Production couldn't keep up. Supply chains broke. Commodities spiked. And suddenly, the word no central banker wants to hear came back. Inflation. By 2021, it was undeniable. U.S. inflation hit 5%, then 7%, then 9%. Europe followed. Emerging markets began to wobble. So in 2022, central banks flipped again, from printing to tightening. The Fed raised rates 11 times in 18 months, pushing the benchmark rate to 5.25%, the fastest hiking cycle since the Volcker era of the 1980s. And the result? Everything that was built on 0% debt began to crack again. Crypto imploded. Silicon Valley Bank collapsed in March 2023, not because of bad loans, but because their long-duration bonds got destroyed by rising rates. Remember that phrase from Part 4? Duration mismatch. It's back. And now we sit in the echo. As of late 2025, global debt has crossed $315 trillion. The U.S. alone is paying over $1 trillion annually in interest on its national debt, more than it spends on defense. Zombie companies, firms that can't cover interest payments from profits, are everywhere. By some estimates, 20% of U.S. publicly listed companies fall into that category. And yet, the system limps on. Why? Because no one wants to be holding the bag when it breaks. Every politician, central banker, and corporate CFO is playing the same game. Delay the reckoning, refinance the debt, hope for a soft landing, kick the can, and pray someone else catches it. But the can is getting heavier. In 2026, several things are set to collide. Record corporate debt maturities, over $2 trillion due in the U.S. alone. Soaring deficits. The U.S. Treasury will need to issue over $1.5 trillion in new debt just to cover basic obligations. Rising rates. Unless the Fed pivots again, borrowing will stay expensive. Political instability, with global elections, trade tension, and populist pressure mounting. And the worst part? The same mechanism that broke in 2018 is still in place. Central banks still control liquidity. Markets still expect rescue. Debt is still structured short-term, fragile, and over-leveraged. The difference? In 2018, there was still room to cut. Now, with inflation lurking and rates already high, the Fed's margin for maneuver is razor thin. It's like the gold exchange standard in the 1920s. Governments tried to re-anchor the system with confidence without changing the underlying math. They failed, because confidence doesn't roll over debt. Interest does. So if you're wondering why the markets feel off, why even strong companies wobble, why credit feels tight, why growth feels fake, it's because we're living in the echo of a broken system, patched with political promises and central bank smoke. They thought 2018 was a warning, but it was actually the last clean exit. The next break, the one coming, won't be a tremor. It'll be a fracture. There's a law in history that no empire escapes, a rule that outlives kings, currencies, and constitutions. Arithmetic cannot be deceived. For 10 years, the post-2008 world ran on delay. Push rates to zero, print money to plug holes, buy assets to simulate growth. But delay is not repair. And now, the bill is arriving, with compound interest. What began in 2018 wasn't a crash. It was the system blinking. A momentary blackout in the illusion of control. The lights came back on, but the wiring was never fixed. And so we drifted forward, deeper into leverage, wider into debt, higher into illusion, until the choices narrowed. In 2018, the Fed chose to back down. In 2020, they doubled down. In 2026, there may be no safe option left. Because when systems are built on artificial inputs, be it printed money, subsidized debt, or political denial, the end isn't chosen, it's triggered by math, by maturities, by the silent mechanics no speech can cancel. Just like France in 1796, when assignats became worthless paper. Just like the British Empire in 1931, when gold convertibility cracked. Just like Argentina in 2001, when the peso peg snapped overnight. The story is always the same. Money is trust, and trust has limits. If you hear this in 2025, don't mistake calm for stability. The fuse is slow, but it is burning. And history only looks obvious after the break. So ask yourself, what happens when debt can't be rolled? When the Fed can't cut? When the buyers disappear, not because of fear, but because of math? That's not a prediction. It's a structure. And structures don't lie. They can be delayed, they can be manipulated, but they cannot be ignored forever. If 2018 was the whisper, 2026 may be the reply. If this changed how you see the last decade, share this video. Not for the algorithm, for the archive. So when the next chapter opens, you'll know it didn't come from nowhere. It came from arithmetic.